If your trading is giving you inconsistent results, most probably it's not because of bad setup, but because you are applying a good setup and random stocks. Like this zone, which we call accumulation. This is IPO base, and we can see the accumulation happening right over here. Here the price is not moving anywhere, but the price action is choppy. No significant volume we can observe over here. There are some spikes, but the spikes are on both sides during the up move and during the leg move also. If you use a good setup in this zone, your results will be random. So randomness is not created by your setup or random markets. Random stock selection creates randomness, and this is what this video will solve. In this zone, the stock is neglected by the institutions. This is a neglected zone. You can see the institutions stepping up on the right side by observing the volume spikes and price moving up. Here it is the resistance line, a trend line showing the resistance of accumulation zone. With this wide range candle and big volume, the stock breaks out of this zone. And this breakout means the stock has changed its nature. It's no more sideways. It's going to be in trend. If we trade strong stock, which means a stock in an uptrend where institutional interest is clearly visible. And how do we see institutional interest? If there are one-day wonders, and what do I mean by one-day wonders is if you see a single candle with wide range and volume, it's a one-day wonder if there is no follow-through. So you are to ignore that too. Institutions don't buy a single day, they buy a few days and they stop buying. That the supply come to the market. Here the institutions broke out over here and supply was visible on 3-4 days. Right at the resistance they stopped buying and the price went sideways. They again stepped up and price moved ahead. Now it's confirmed that stock is going to be in stage 2 or growth stage. These wide range candles and high volumes defines the real strength. These candles and these volumes matter because they are the footprints of big money, smart money, the institutions stepping in the stock. And also you will find highest volume in quarter, highest volume in year or highest volume ever in these zones. And this is the evidence. It's not a signal. This is the evidence that institutions are stepping in. Let's move to the growth phase. In the growth phase, you will see the continuous follow-throughs with highest volume and sideways or pullbacks with lower volumes. What are they buying? And they stopped over here. They let the supply come into the market. If the supply is less, you will see the sideways mild pullbacks with lower volumes. When the supply stopped, they again stepped up their buying. So we again see wide range candles moving up with high volumes, and again we see the prices moving downwards with low volumes, and the institutions again step in once the supply is absorbed. Also, you will find inside days narrow range 4, narrow range 7 during these pauses. The volume will also shrink during the sideways or pullbacks. You will find the lowest volume in quarter, lowest volume in year, or lowest volume ever. And these phases, these pauses forms flags, wedges. You will also find coil spring price action right over here. These tight zones, these tight candles is where the supply has been absorbed. If there was bigger supply, the price would have fallen quickly with huge volumes. The tightness of the candles and less volume indicate that supply is not available. You will observe that sometimes very narrow candles form right over here. It's a very narrow candle with almost lowest volume in many days. Very next day, the institutions steps up their buying and price moves through the path of least resistance. What do I mean by the path of least resistance? That means on the way up, the price will face very less supply. With very less supply, the price will move big. So we have to see the highest volume, the high volumes when the price is moving up, and low volumes during the sideways or pullback. During the up move, the candle size will be big, and during the sideways move, the most candles will be tight and smaller. And these opportunities will keep appearing repeatedly, especially during the initial growth stage. During the later stages, you will observe some big red candles with volume. These zones gives us opportunity to enter with asymmetric risk reward. We can enter over here with the least risk and take huge profits. Another example, price went to the accumulation, broken out with volume, a follow through, tight ranges. These tight ranges give us asymmetric risk and reward. And as we discussed, the price behavior during the initial growth stage is different from the price behavior during the late stage of growth. Here we can observe bigger candles, but still we will find some asymmetric risk and reward. We have to be careful during this phase. Till now we saw smaller bases, smaller pauses during the growth phase. Now look at this stock. It moved around 200%, then formed a very big base. Again 125%, 28%, again formed a big base. These big bases are different from the smaller bases we saw earlier in our previous example. You can treat these big bases as another accumulation. We can assume the growth phase starting from right over here. Breakout with high volumes and range expansion. Pullback, expansion with high volume, and contraction, tightness, both in price and volume. So we are again getting low risk, high reward opportunities, and this will keep on happening. The breakout from these big bases indicates a renewed institutional interest. Here the institutions were no longer buying in this particular stock for whatever the reason it may be, but this expansion, this breakout and expansion indicate the institutions are again interested in this stock. With the smart money's interest, we are also interested in this stock. During the accumulation or big basis, you will also see the high, which indicates a trend. Now growth stage can also be identified by using the theory higher highs, higher low, higher high, higher lows. This structure reflects the control of institutions. That's where we get asymmetric risk reward trades. Now we understand high volume, price expansion, low volume, price contraction. We see higher highs, higher lows. We see contracted volumes inside days, narrow range 4, narrow range 7, price tightening, the coil spring effects, volatility compression patterns, and we see where we are very clear about the direction of the move. These are the high probability areas for our trade to be successful then in this zone. Once a stock is no more random, no more choppy, no more sideways, but in a clear trend where strength is visible by means of wide expansions with high volumes and tight contractions with volume tightness also. In the next video, we will step back and go through the all stages. Thank you.